Hello, everyone, and my name is Babatunde Onabajo, and this is a presentation for the 2025, well, it's now 2026 LMA or Loan Markets Association Edge hackathon. So, this hackathon relates to um, basically seeking out the latest technologies relating to the loan loans industries. Now, the loan market is probably one of the most influential institutions that we have in society today. The economic historian Neil Ferguson once remarked that credit is perhaps humanity's greatest invention. And as someone from an economics background, uh, the loans the loanable sector is also a fundamental part of the economy. It's been shown that having access to credit is one of the key drivers of economic growth. Similarly, the accessibility or the extent of the accessibility to the level of credit is what also influences the business cycle. So effectively, the ups and downs of the economy, whether the economy is expanding or contracting. So the tool that I've developed for this hackathon, which seems to be seeking out for new solutions relating to the loanable market sector, um, is basically one that tries to visualize the relationship between financial uh, institutions. Now, somewhat recently, I've developed a very strong interest. Oh, is this still recording? Oh, yes, it's still recording. So, somewhat recently, I've developed a very strong interest in something called network theory. Network theory is basically effectively a branch of mathematics, but it's used in the social sciences such as economics, sociology, political science, and so forth, that tries to gauge the relationship between different entities. So networks are all around us. For example, when you go to a social network, you're not just going there by yourself. The social network is basically based on the relationship that you have with others, be it the number of friends that you have, how influential people within that friendship circle is, and so on and so forth. Well, this program that I've developed for this hackathon is basically a tool that visualizes the uh, the risk of what is called financial contagion. So in any kind of social network, there's also the ability for something to spread, and that thing that is spreading can be anything, whether it's disease, information, influence, and so on and so forth. A perfect example that we have seen in recent years, demonstrating the what is called contagion, um, is the COVID-19 pandemic. And with that pandemic, we saw how people had to be isolated to prevent the disease spreading. So there was lockdown measures and quarantining and other measures that public bodies across the world took to try to address uh, the virus that was spreading throughout society. Well, there's also a concept in economics known as financial contagion. So what happens is that sometimes in some parts of the business cycle, when when a business lends to another business, they have what is called exposure or exposure risk. Now, if too many banks or other financial institutions do not pay on time, then that causes the system as a whole to be vulnerable. And when that vulnerability expands and spreads through to different banks, we call that contagion. When it becomes too widespread, then it can cause what is known as systemic risks to the economy. And there's different regulatory requirements that have been made to address this, such as the Basel capital requirements and so on and so forth. But what this program basically does is that um, it's basically trying to visualize the level of visualization for financial institutions so that they can see uh, what kind of exposure they're putting themselves into when they lend money to a certain bank. Now, this program it uses Companies House data. Companies House here in the United Kingdom is basically the central database for companies throughout the UK, if you want to incorporate a company in the United Kingdom, you have to register through Companies House, and that's pretty much a requirement for everyone. And in fact, the rules are actually tightening even now uh, for overseas institutions that want to operate in the United Kingdom through the economic transparency and corporate crime transparent economic crime and corporate transparency Act 2022. But uh, that's a different presentation for another day. Let's actually go to this program for just a second. So obviously, for legal reasons, we won't use actual company information here because we don't want to perhaps embarrass some companies or say that perhaps they're at a risk of insolvency to a public platform. So this program is actually vibe coded with the help of Anthropic. So we'll use the demo mode here. So we've clicked this, and we'll just add various companies to see this program in to see this program in action. So let's name the first bank Bank One, and again any like coincident. So any same equivalent name is basically coincidental. Let's just add random numbers for Bank One. It's a limited company, and we'll put the risk score as 67. Let's say we'll create another connection. Let's say TradeWise or PayFast Technologies. Again, totally random name. We'll add a connection to Bank One. Let's say PayFast Technologies, Bank One, and against a financial company. And we'll put the risk score as 54. And so we click Create Connection. So you can see here, it uses this library called d3.js to visualize connections between different banks or financial institutions. So you can see here that there's a number of there's a categorization of different risk levels. So there's low risk, there's medium risk, and there's high risk. And depending on what risk level the financial institution is, it gets the according color. So for example, low risk, which is gauges between 0 and 40, that's been given like a green score. Medium risk has been given an orange score, that's between 40 to 70. And high risk has been given a red score, which is 70 to 100. And so you can actually click on this program here, and it will visualize the level of connections. So it will visualize the level of exposure. So here it shows the different connections that various financial institutions have. So for example, Citibank is connected to Megabank. So that indicates that there's a relationship between themselves. But Citibank is not related to TradeWise brokers since there is no direct connection between them. However, if you look at the lines very closely, you can see that the more exposed a particular bank is, the greater what is called the edge, the greater the width of the edge. And so you can also very quickly see what the concept of contagion is. So for example, here, if this beggar bank, for example, fails, then suddenly you see how Capital Ventures, here again, any equivalent name is just coincidental, would also collapse. Then Growth Fund as well would also collapse. So one of the reasons why this is so I wouldn't say revolutionary, but one of the reasons why it's a paradigm shift for the loan sector is that with the loan sector is that many employees within the industry tend to rely on things what are known as basically tabular databases. So that can be anything from Microsoft Excel to SQL. But there's been a recent shift in some academic circles that this kind of representation of data is perhaps not so suitable for the interconnected society that we live in the world today. And where one institution fails, we can quickly experience how society as a whole can fail. And in fact, I've seen that also within my own lifetime. For example, during the 2008 financial crisis, when Northern Rock here in the United Kingdom collapsed, we saw how that bank, which a lot of us had never even heard about before, had quickly uh, caused greater trouble to other financial institutions just because of that one bank. So, thank you so much for listening to my presentation. My name is Babatunde Onabajo, and it's been a pleasure to create this presentation for the LMA Edge hackathon. As a side note, I don't have any experience working with the Loan Bull Markets Association itself, but I did actually work for a related organization previously called the British Bankers Association, or BBA, and one of the responsibilities was setting the LIBOR rate. Uh, LIBOR is the London Interbank Offered Rate here in London. So it's kind of the same sector. So this was something that resonated with me a lot. So thank you so much.